What is going on, my friends? It's great to see you guys. My name is Ryan Williams, and in today's video, we are going to be talking about a very special type of dividend stock that's known for its extremely high yields and awesome tax benefits. That's right, today we are going to be talking about master limited partnerships, also known as MLPs. In this video, guys, we are going to be covering exactly what MLPs are, how they can achieve such extremely high yields like 6, 7, 8+% yields, and how you can generate tax-free income from owning shares in them. Also, at the end of this video, we'll get into a couple examples of some MLPs, so be sure to stick around for that. Anyway, before we get rocking and rolling, if you guys like the idea of getting a 6, 7, 8% dividend yield, which is extremely high, go ahead and give this video a big fat thumbs up. Awesome. Thank you guys so much for doing that. I really appreciate it. And now, without further ado, let's get into it. Alright guys, so the first question that I'd like to address in this video is, what are MLPs? And to answer that, we are going to refer to the definition from Investopedia.com, which is kind of my go-to source for a lot of this stuff. Anyway guys, Investopedia.com defines master limited partnerships as a business venture that exists in the form of a publicly traded limited partnership. They combine the tax benefits of a private partnership. Profits are taxed only when investors receive distributions with the liquidity of a publicly traded company. Now, right off the bat, just based on that definition, it doesn't sound like MLPs are too entirely different from the regular dividend-paying companies that we usually look at, like the Coca-Colas or the McDonald's, right? And really, there's only a few key differences between regular companies and MLPs, which we'll get to in just a moment. But a couple key notes on MLPs: they are limited to just the natural resource and real estate sectors. In fact, a lot of the MLP companies that are out there are midstream pipeline companies, with the first one being established about 30 years ago in 1981. And to further elaborate on a little bit of the MLP history, I'll read an excerpt from this article I found from Yahoo from earlier this year. The article reads, "MLP structure has been around since 1981. It was when oil and gas producer Apache Petroleum Corporation started offering investors the tax advantage of a partnership with the liquidity of publicly traded securities like stocks and bonds. The model was so successful that most companies in different industries started duplicating it. However, Congress made a decision to limit these types of businesses with the Tax Reform Act of 1986 and the Revenue Act of 1987. These laws determined that an MLP must earn at least 90% of its gross income from qualifying sources to obtain the tax benefits of a pass-through." Now, this ties in perfectly to the next point. At the very end of that excerpt, it mentioned pass-through. So MLPs are what are referred to as pass-through entities, which means that their profits and losses are distributed or passed on to us as shareholders. But when it comes to MLPs, shareholders are referred to as partners. And MLPs have two different types of partners. You have general partners, who are the people that manage and oversee the day-to-day operations of the MLP. And then you have limited partners, who are people like you and me who simply just want to invest in the companies. Now, because MLPs have to distribute or pass on the profits to partners like us, they're able to generate much higher yields than regular dividend-paying companies like Coca-Cola or McDonald's. Instead of a 2 to 4% dividend yield, which is what we'd see from most regular dividend-paying companies, it's not uncommon to see MLPs throwing out 6, 7, 8+% yields. In addition to being pass-through entities, one of the other key differences between MLPs and regular companies is that when you get paid from these companies, it's not a dividend. It's actually what is referred to as a distribution. They're actually very similar in the sense that it's just cash flow that you get from owning shares in these companies, but where distributions differ from the dividends that we know and love is how they're taxed. With dividends, as you guys may or may not know, there are qualified dividends, which you pay taxes on, and then there are ordinary dividends, which you actually pay a little bit more taxes on. Distributions, however, are not treated as cash flow. Instead, they're looked at as a return of capital, and therefore you don't have to pay any income taxes on them unless you decide to sell your shares in the MLP, in which case you'd be taxed at the lower capital gains rate, which is still not as bad as paying ordinary income taxes. Also, if you do decide to sell, one important thing to note is that the distributions are subtracted from your cost basis, which can result in you paying more taxes if you decide to let go of your shares. And I'll give an example real quick. So if you bought one share of an MLP at $10 per share and you got a distribution of $1, that means your new cost basis would be $9. This over time creates more of a difference between your cost basis and your market value, which the dollar amount in between is what you end up paying taxes on. And the greater the difference between these two numbers at the time of selling, the more taxes you're going to end up paying, which is not fun. And I know, guys, I just said you don't have to pay any taxes on the income you receive from MLPs, but you still have to report that income to the IRS. Anyway, the thing that is pretty unideal about this situation is that you have to report the income you receive from these MLPs on a totally separate form. Instead of that income being included on the 1099 you receive from your brokerage, which shows your total dividend income from all your holdings, you get a separate form called a Schedule K1 from the MLP. Now, I just went through this earlier this year when I did my taxes, and to be honest with you guys, it really was not that bad. It took me just like an extra couple of minutes to report everything, and if you use a software like TurboTax or whatever, it's pretty easy to report this extra form. But it's still one extra step you have to take when doing your taxes, and I totally get it. Nobody even wants to be doing them in the first place. So long story short, guys, if you're going to be buying an MLP, it's typically best not to sell so you can avoid paying those taxes. And I know this was a lot of information to throw at you guys at once, so if you have any questions or need any clarification, just hit me in the comments below. I'm happy to answer. All right, guys, now moving on, one of the other differences between MLPs and regular dividend-paying companies is how you analyze them. With most companies, we can simply just look at the PE ratio to help us determine affordability, but seeing as MLPs pay out most of their earnings to their partners, the PE ratio is just not going to cut it, so we need to look to a different metric that we can use to determine affordability. And for that, we're going to look to somewhat of a similar metric called the price to distributable cash flow. This is pretty easy to calculate and can be done so by taking the company's market cap and dividing it by its distributable cash flow, which can be found on the company's reportings, as you can see on the screen right now. And I'll show you guys an example of how to calculate this in just a moment, but in the meantime, as a general rule of thumb, the lower the price to distributable cash flow, the better, and it's very similar to PE ratios in that regard. Now, one other metric we use when analyzing MLPs specifically is the distributable cash flow coverage ratio. And this is super easy to calculate as well and can be done so by dividing the company's distributable cash flow by its distributions paid that year, and this number helps us determine how sustainable or how safe the distributions might be. Now, you want this number to be over 1.0 because otherwise it means that the company is paying out more in distributions than it has in distributable cash flow, and if a company does that year after year, it doesn't bode well for the distribution, which means that the company might not be the best long-term investment. And as a general rule of thumb, guys, just to keep it simple, look for a distributable cash flow coverage ratio that is greater than 1. All right, guys, now moving on, I want to get into a couple examples of some MLPs. And the very first one I want to start with is one that I actually own in my own portfolio. It's the only MLP I have, and that's Enterprise Products Partners, ticker symbol EPD. In fact, I just picked up a few more shares of EPD not too long ago. If you guys saw my last video where I invested $1,000 into dividend stocks, you'll have seen me purchase like 10 shares of EPD. But anyway, a little bit about EPD, guys. So let's start with some of those metrics that we just covered, the price to distributable cash flow and the distributable cash flow coverage ratio. So EPD has a current market cap of $53.47 billion and a distributable cash flow of $6.41 billion in the year 2020. So if you remember, to get the price of distributable cash flow, we're going to take that market cap, divide it by distributable cash flow, and that should give us a price to distributable cash flow of 8.34, which, if we're using kind of the same rule of thumb as we do for PE ratio, means that EPD is pretty dang affordable. And for the next metric, EPD has a distributable cash flow coverage ratio of 1.63, which is good. Remember the general rule of thumb, anything above 1.0 is good. And let's talk about the dividend stats real quick. So EPD has a current dividend yield of 7.44%, which is extremely high, guys. A payout ratio of over 80%, which, remember, they're paying out most of their profits to us as the partners, so a high payout ratio is to be expected. And their dividend has a 5-year growth rate of 2.92%, which is pretty low, but the dividend yield is pretty high, so it's not as big of a concern. And EPD has been committed to growing their dividend. As we can see here, they have 22 years of consecutive growth. EPD has done pretty well so far for me, guys, and I can see it playing a bigger role in my portfolio. Right now, it's maybe between 5 and 6%, but I could see that being higher as time goes on. I really like this company. All right, guys, now the next MLP I want to talk about is another very popular one, and that's Magellan Midstream Partners, ticker symbol MMP. Now, MMP has a current market cap of $10.91 billion and a distributable cash flow in the year 2020 2020 of 1.04 billion. So if we divide the two, we get a price to distributable cash flow of 10.49, which is still very low, albeit not as affordable as EPD, but 10.49 is not bad by any means. Next, their distributable cash flow coverage ratio is 1.13, which also is not as high as EPD's, but it's over 1, which is good. As long as it's over 1.0, that's really all that we want to see. It's sustaining its distributions. And as far as the dividend stats goes, guys, MMP has a current dividend yield of 8.52%, which is, that's probably one of the highest I've ever seen, guys. That's extremely high. A very high payout ratio of almost 98%, 97.5%. But don't worry, guys, it's paying out most of that to us as the partners. Its 5-year growth rate is actually not too bad, almost 6%, and its dividend growth is not bad either. 19 years of consecutive dividend growth. That's what I like to see. In my opinion, guys, if you're looking for an MLP to add to your portfolio, you can't go wrong with either of these two. With that said, do a little bit more research into them. Let me know what you guys think about either of these two companies in the comments below. I'm sure there's some of you guys out there who have one or both of these stocks in your portfolio. If you guys have either of these stocks, let me know what you think about them in the comments below. I'd love to hear your feedback. All right, my friends, well, that pretty much wraps it up for today's video. Thank you guys so much if you have stuck through with me to the end. I really appreciate you taking the time to watch these all the way through. If you haven't done so already and you enjoyed watching this video, please don't forget to give it a big thumbs up before you click off to the next one. And also, whether you're new to my channel, whether you've seen a few of my videos, or whether you watch every single one of them, if you are not subscribed already, please consider doing so. At this point, I'm putting out videos twice a week, every Wednesday and every Sunday, so there is a lot of good dividend stock content guaranteed to be coming your way, and I don't want you to miss out. Anyway, with that said, I will now get out of your guys' hair. Thank you so much for watching this video. I really appreciate it. Hope you guys have a great day, and I will see you in the next one.